Reinsurance Group of America, ticker NYSE RGA, delivered a massive bottom-line beat for Q2 2026.
Huge beat.
Yeah, adjusted operating EPS came in at $8.89, which just completely crushed the Wall Street consensus of $6.53.
I mean, that is a 36.14% beat.
Right. But contrast this immediately with the revenue miss, because total operating revenues were $6.64 billion, missing the $6.68 billion estimate by about 0.6%.
Right, a slight miss there.
Yeah. And management kept their intermediate term targets unchanged. So projecting 8% to 10% annual EPS growth and a 13% to 15% return on equity.
Which the market clearly loved.
Oh, absolutely. RGA shares jumped in the after-hours session and gapped up the next day. It closed the August 7th session up 4.24% at $246.33, hitting an intraday all-time high of $248.13 on really heavy institutional volume.
So as retail investors, you really need to understand why the market rewarded a top-line revenue miss with an all-time high stock price.
Exactly.
So the mission of this deep dive is to unpack the margin efficiency, the asset performance, and honestly, the underlying risks hidden in this earnings report.
Right, because to understand that disconnect, between the revenue missing and the stock just soaring, we really have to look at the profitability of the individual business segments. Across the board, GAAP net income climbed 156.7% year over year to $462 million. But the standout metric, the one that really jumps out, came from the U.S. and Latin America traditional segment.
Oh, yeah. That number was wild.
Pre-tax operating income there hit $165 million. That is up 4,025% from just $4 million a year ago.
It's a staggering figure.
It is. And meanwhile, the U.S. and Latin America Financial Solutions segment, that also surged 58.8% to $154 million, driven mostly by the Equitable transaction.
Right.
But looking at that 4,025% jump, as an analyst, my immediate instinct is just total skepticism.
Sure, as it should be.
Right. Like when you see a segment jump 4,000% year over year, is that just an easy comparison against a genuinely terrible quarter last year, or is something structural actually happening with mortality trends?
Well, that skepticism is entirely warranted. A 4,000% increase should always, prompt a closer look at the underlying mechanics.
Yeah.
But when we dig into the drivers for that specific segment, RGA actually experienced a $31 million economic tailwind stemming directly from highly favorable biometric claims and mortality trends.
Okay, so it was real.
It was real. And of that $31 million, $14 million flowed directly into their current period earnings.
So let's break down the mechanics of, favorable biometric claims, because it really gets to the core of how life reinsurance works.
Yeah, let's do it.
Essentially, an insurance company relies heavily on these complex actuarial models to predict how many people in a given population will, pass away or become severely ill in a specific quarter.
Exactly.
And they reserve a massive pool of capital based on those predictions. So favorable biometric claims mean the actual reality came in lower than their statistical models projected, right?
That captures the dynamic perfectly. In the life and health reinsurance sector, the primary cost of goods sold isn't, manufacturing a physical product.
Right.
It is paying out death benefits and health claims. So when broader population health trends improve, or honestly, more importantly, when a reinsurer's initial risk selection and underwriting criteria are just exceptionally accurate,
then the payouts drop.
Exactly. The actual payouts fall short of the capital they initially set aside. That differential, the reserved capital that wasn't actually needed to pay claims, drops straight to the bottom line as pure profit.
Wow. And it suggests this wasn't just like a lucky quarter regarding mortality rates.
No, not at all.
It acts as a real-time validation of their pricing power and their disciplined underwriting. They aren't just taking on any risk to boost their premium revenue, they're really curating the risk.
Curating is a great word for it. And that efficiency on the liability side of the balance sheet is exactly what drove their trailing 12-month adjusted operating return on equity to an impressive 18.4%.
That's when we exclude some notable items.
Right, excluding one-offs. But still, 18.4% just obliterates their 13% to 15% target range.
It really does. So if they are paying out fewer claims than expected, that naturally means they're holding on to more cash.
Yep.
And in the insurance industry, an underwriting surplus is kind of only half the story, right? The real power of a reinsurer is how they actually deploy that liquidity.
The float.
Exactly. The premiums they collect minus the claims they pay out create the float. And that float fuels the investment engine, which is where we see the rest of this earnings beat compounding.
Yeah, the liability side and the asset side are intrinsically linked. You really cannot separate RGA's underwriting discipline from their asset management strategy.
Right.
The longer they hold on to that float without having to pay a claim, the more aggressively they can put that capital to work in the financial markets.
And they put it to work with serious momentum in the second quarter. Let's look at the variable investment income, or 7.
This was a huge part of the beat.
It was. RGA generated $166 million in 7 for the quarter, beating expectations by $90 million.
A massive beat.
And a large portion of that outperformance was fueled by a 15% annualized return in their alternative equity portfolio, which sits at about $4.1 billion, right?
Right.
In the context of a typically conservative insurance portfolio, a 15% annualized return is just an aggressive outperformance.
It is. And it really highlights the effectiveness of a bifurcated asset strategy. Reinsurers maintain a massive, highly conservative core portfolio of fixed income assets.
Just to ensure they can always meet their claim obligations.
Exactly. But they carve out this alternative equity bucket, which often includes, private equity, real estate, and private credit, specifically to chase higher yields.
Got it.
So for this quarter, that $4.1 billion alternative bucket vastly outperformed their internal benchmark, which was modeled at just a 7% return target for the year.
So they more than doubled it.
They did. But while a 15% return is excellent for the bottom line today, you have to look at the core fixed income portfolio to understand the structural long-term tailwind here.
Right, because alternative equities are inherently volatile. I mean, they can return 15% one quarter and be flat or even negative the next.
Exactly.
The fixed income portfolio is the actual bedrock of the balance sheet. So RGA's core portfolio yield is currently sitting at 4.96%.
Yeah.
But their new money rate, which is the yield they are securing on the cash they are deploying into the markets today, has jumped to 6.02%.
And that is the key metric.
Yeah, that creates a 106 basis point gap, which I know analysts call an embedded reinvestment spread.
And understanding the mechanics of that 106 basis point spread is crucial for grasping why the stock hit all-time highs.
Okay, let's unpack that for the listener.
Life insurance liabilities are long-duration obligations, right? A policy might not pay out for 10, 20, or 30 years.
Right.
To match that duration, reinsurers buy long-term bonds. Many of the bonds currently sitting in RGA's portfolio were purchased years ago during the zero interest rate environment.
Oh, I see. It functions very much like managing a ladder of certificates of deposit for a retail saver.
Perfect analogy.
Like if I built a ladder of 5-year CDs back in 2020 or 2021, I was locking up my capital for yields of, 1% or 2%?
If you were lucky.
Right. Now, as we sit in a higher rate environment, those old CDs are finally reaching maturity. They turn back into liquid cash.
Yep.
I don't have to contribute any new savings. I simply walk back into the bank and reinvest that exact same principal into a brand new CD yielding 5% or 6%.
Exactly.
So my passive income jumps significantly purely because the macroeconomic environment shifted beneath me.
And that exact dynamic is playing out at an institutional scale for RGA. As billions of dollars in older, low-yielding bonds organically mature, they are taking that principal and reinvesting it at today's 6.02% rate.
Wow.
This embedded reinvestment spread is arguably the most valuable component of their earnings report because it is highly predictable.
It doesn't rely on a bull market in equities.
Right, and it doesn't require further improvements in mortality rates. It is simply the mechanical, gradual repricing of a massive fixed income portfolio catching up to the current interest rate environment.
Which provides a multi-year runway for earnings growth, even if premium volume just completely stagnates.
Precisely.
So all of this margin efficiency and investment outperformance leaves management with a significant amount of liquidity.
Yes. $2.2 billion at quarter end.
Right. At the end of the quarter, sitting on $2.2 billion in excess capital, and management is deploying that capital across a few different avenues.
They've been very proactive here.
Yeah, they announced a planned $400 million debt paydown scheduled for September 2026, which obviously will naturally reduce their interest expense and improve their leverage ratios.
Always a good move.
And they also increased the quarterly dividend by 5.4% to $9.08 per share.
And beyond the debt reduction and the dividend, they're actively managing their equity structure too. They are executing against a $500 million share buyback authorization.
Okay.
But perhaps the most critical use of that excess capital is their $1.5 billion annual target for in-force block acquisitions.
Let's expand on that, because buying an in-force block is very different from winning new individual policy.
Oh, entirely different.
When RGA executes an in-force block acquisition, they are essentially taking over an entire existing portfolio of mature insurance policies from a primary carrier.
Yep.
The primary carrier gets a lump sum of capital relief, and RGA takes over the administration, the premium collection, and all the future claim liabilities of those policies.
Right. It allows RGA to scale their assets under management rapidly without having to spend, marketing or underwriting dollars to acquire policyholders one by one.
That's incredibly efficient.
It is. They use their strong capital position to act as a liquidity provider for the rest of the insurance industry, buying up these legacy blocks when the pricing metrics align with their ROE targets.
But this strategy of buying other companies' legacy blocks brings us to a critical tension in this earnings report.
The bear case.
Exactly. If they have so much capital to acquire external growth, why is their organic top-line revenue shrinking?
That's a great question.
Consolidated net premiums came in at $4.47 billion, which missed Wall Street estimates by 4.2%. And when we dig into the regional data, the U.S. and Latin American traditional premiums actually declined 1.2% to $1.96 billion.
Yeah, they caught some people off guard.
At first glance, a shrinking premium base looks like a failure to compete, but the underlying reason here is driven by something called treaty recaptures.
Yes, treaty recaptures are the primary headwind to their top-line growth right now. To understand why this is happening, you really have to look at the relationship between primary insurance carriers, the companies selling directly to consumers, and reinsurers like RGA.
Okay, traditionally, a primary carrier offloads a portion of their risk and a proportional share of the premiums to a reinsurer, right?
Exactly.
They do this to mitigate their own exposure to catastrophic loss and to free up regulatory capital so they can go out and write even more new business.
That's the standard model.
But the macroeconomic shift we discussed earlier, the higher interest rate environment, it totally changes the math for the primary carriers.
It really does.
They're looking at the 6% yields available in the bond market and realizing the premiums they usually pass off to RGA are suddenly much more valuable.
Right. The primary carriers are running the numbers and deciding they no longer need the capital relief as desperately as they did in a low-rate environment.
So they pull it back.
Exactly. By executing a treaty recapture, the primary carrier is contractually recalling the business. They take back the risk, but they also take back the premium cash flow, allowing them to invest it themselves and capture that 6% yield.
It creates a fascinating paradox. The prolonged high-interest rate environment is the exact catalyst driving RGA's reinvestment spread and boosting their bottom line, but it is simultaneously incentivizing their clients to pull business in-house.
Which suppresses RGA's top-line revenue.
Exactly. And treaty recaptures aren't the only headwind. Operating profits in the Asia-Pacific region were pressured by foreign exchange drags, and their adjusted operating tax rate landed at 23.1%, which sits at the very ceiling of their expected range.
So when you combine the top-line miss, the treaty recaptures, and the macroeconomic pressures, it naturally invites bearish scrutiny from Wall Street analysts, who prioritize consistent revenue expansion.
Right.
But the way management addressed this friction on the earnings call was quite calculated. CEO Tony Chang and CFO Laura Hay purposefully refused to issue short-term, quarter-to-quarter guidance for revenue or earnings.
And refusing to play the short-term balance game usually frustrates institutional analysts who build their models quarter by quarter.
Oh, absolutely. They hate it.
But management is trying to force the market to evaluate them on long-term capital efficiency rather than sheer volume.
Right.
They are arguing that a decline in top-line revenue is actually a strategic victory if the revenue you were losing was attached to poor risk.
Exactly.
For instance, they highlighted that over the last 3.5 years, since adopting a new accounting standard, they have actively reduced their exposure to capped cohorts by 25% in the U.S. market.
And shrinking their exposure to capped cohorts is a prime example of choosing margin quality over revenue quantity.
Let's explain what those are.
Yeah. To understand why management is so eager to shed this specific business, we have to look at the mechanical structure of a capped cohort. These are legacy blocks of insurance policies, often older long-term care products or specific types of annuities with secondary guarantees.
And the mechanics of those legacy policies are inherently lopsided, right?
Highly lopsided.
The capped aspect means the upside profit for the reinsurer is mathematically limited by the terms of the contract.
Right.
Like no matter how well the investment portfolio performs, the reinsurer can only extract a fixed margin. However, the downside risk is totally uncapped.
Which is terrifying for a reinsurer.
Right. If policyholders live significantly longer than expected, or if the underlying cost of long-term healthcare surges exponentially, the reinsurer is on the hook for those spiraling costs.
It creates an asymmetric risk profile that destroys capital efficiency. By intentionally walking away from these capped cohorts, RGA is voluntarily giving up the premium revenue associated with those policies.
Which makes their top-line growth look sluggish.
Exactly. But by shedding that toxic tail risk, the earnings that do remain on the balance sheet are of significantly higher quality, they're much less volatile, and they require way less capital to support.
It fundamentally reshapes the risk profile of the company.
It does.
They are willing to be a smaller company on the top line if it makes them a far more profitable company on the bottom line.
Precisely.
And this brings us to the valuation setup for the retail investor trying to make sense of all these conflicting dynamics.
There's a lot to weigh here.
We have a stock sitting at all-time highs, propelled by exceptional margin efficiency and investment returns, yet facing structural headwinds on premium volume and a management team deliberately shedding certain lines of business.
Right, and the valuation metrics reveal a stark disconnect between how the market is pricing the equity today versus what Wall Street analysts are projecting for the future.
How so?
Well, despite the stock price gapping up to historical highs, RGA is still trading at a forward price-to-earnings ratio of roughly 13.15.
Okay.
In the context of the broader financial sector, a 13 multiple for a company generating an 18.4% return on equity suggests the market is still somewhat skeptical about the sustainability of these earnings.
And the skepticism seems primarily directed at that massive variable investment income beat.
Yep.
The market appears to be assuming that the 15% return on alternative equities will eventually mean revert to historical averages. But the institutional estimates actually suggest otherwise, don't they?
They do. The current consensus estimate is projecting a fairly aggressive 17.9% EPS growth rate for 2026.
Wow. That 17.9% growth projection creates a substantial gap when compared directly against management's own commentary.
A huge gap.
Because remember, management reiterated a conservative intermediate-term target of just 8% to 10% annual EPS growth.
Right. Wall Street analysts are effectively baking in a scenario where the elevated alternative investment returns and the wide reinvestment spreads persist indefinitely.
They're modeling best-case scenarios.
While management, by contrast, is maintaining a highly defensive posture, they're constructing their internal models with the assumption that alternative returns will normalize.
So if Wall Street is modeling nearly 18% growth and the executive team is actively planning for, say, 9%, that leaves a wide margin for disappointment if the macro environment shifts.
Yeah.
If the alternative equity portfolio cools off, or if the pace of biometric reserve releases normalizes, it will be incredibly difficult for RGA to meet those inflated analyst expectations purely through organic premium growth.
Especially while treaty recaptures are actively shrinking their existing base.
Exactly. It forces investors to decide which trajectory is more realistic. Is it the mechanical, steady compounder that management is building, or the aggressive growth engine that Wall Street analysts have modeled into their spreadsheets? And it leaves you with a critical macroeconomic puzzle to evaluate moving forward.
It really does.
We've seen how a prolonged high interest rate environment benefits reinsurers through wider reinvestment spreads. But we've also seen how those exact same high rates empower primary insurance carriers to execute treaty recaptures and retain their own premium yields.
It's a double-edged sword.
So if interest rates remain elevated for the long haul and this industry-wide trend of primary carriers retaining their own risk accelerates, how will pure-play reinsurers adapt their business models to a market that increasingly wants to keep the most lucrative risk entirely in-house?
It's a great question to think about.
Make sure you follow the show for daily earnings coverage.